This is the Capital Market on Channels Television. Hello and welcome to the program. I'm Edidiong Iwang. The six-week losing streak in the market came to a halt this week as investors reacted positively to juicy dividend declared by blue-chip companies Dangote Cement and Stanbic IBTC Bank. The all-share index rose 2.17% week-on-week to close at 39,216.20 points, with the year-to-date loss moderating to minus 2.6%. However, activity levels were mixed as trading volumes declined by 34.7%, while value traded rose by 10.6% week-on-week. Bargain hunting in bellwether stocks, Stanbic, Boa Cement, Dangote Cement, and MTN Nigeria drove the weekly gain. Sectoral performance was mostly positive as all sectors closed in the green. The industrial goods index led the gainers chart, followed by the consumer goods, insurance, oil and gas, and banking index. But the bond secondary markets also remained bearish as investors anticipated higher stop rates at the FGN bond auction. The average yield in the space expanded by 31 basis points to 9.8%. Now across the curve, the average yield was higher at the short, mid, and long segments. Now moving to the Treasury bills market, as in prior weeks, the depressed system liquidity underpinned another bearish performance in the Treasury bills secondary market as local banks continued to sell off positions to fund their liquidity obligations. The average yield across all instruments expanded by 30 basis points to 5.6%. Now, across the market segment, the average yield powered by 5 basis points to 6.6% at the OMUM secondary market and expanded by 75 basis points to 4.2% at the Nigerian Treasury bills segment. At this week's OMO auction, the CBN sold 40 billion naira worth of bills to market participants and maintained stop rates across the three tenors as with the previous auction. Now let's turn our attention away from the equities and fixed income markets to the private equity market. And Yomi Jemibewon, the co-founder and managing director of Cardinal Stone Capital Advisors, joins us now to talk more about this. Good evening, Yomi. Thank you for joining us on the program.
Good evening, Edidiong. Thanks for having me.
Well, let's just begin with your review of private equity markets and Cardinal Stone Capital Advisors in 2020. Now, how was the year for you?
2020 for us in private equity as well as at CCA is kind of how it's been for everybody else. A mixed bag, but all in all, positive. We're all still alive and kicking, so we're thankful for that. We had some wins. Some things went well, some things not as well. It was a very surprising year for all of us, but there was a lot of reflection and rethinking of things that we thought were standard and were just, this is how we do things. We had to rethink a lot of those things. And it's actually leading to some better efficiencies and just improving on how we do things generally. But all in all, for us, it was actually a positive year, but with some tempered emotions.
Okay, so how did the COVID-19 pandemic affect or impact your operations and investee companies in 2020?
Okay, for CCA in particular, I'll say in terms of pipeline deals coming in and our ability to assess transactions, it didn't really affect us much, all right? Because we're already used to traveling, not being in the same space, and just working with virtual data rooms and conference calls. So that part wasn't affected. It did affect several aspects of things. Luckily for us as well, we had we were at the tail end of fundraising, so we did not need as much traveling. So that was good. There was a lot of just working very closely with our existing portfolio companies to rethink and troubleshoot, because some of them were really challenged, and I'll talk a little bit about that. And just even amongst ourselves, just how do we do things better? And on some deals that we were actually working progressively on, we had to kind of slow down a bit, see what happened in those industries, ask ourselves, is the pricing still right? Is this the right partner to back? Is it sustainable over the long haul? Because COVID actually raised questions about certain business models and certain businesses as a fact. That is for CCA. In terms of portfolio companies, we had some that were challenged, and we had some that actually were impacted positively. We had an agro business, Crest Agro. Their whole supply chain was disrupted, and that caused really high prices of inputs. For that, that just changed things dramatically for the business. We had to sit down with them, help them restructure their loans, help renegotiate pricing with their key customers. So that was a challenged business that we had to work very closely with. Another business that we had just invested in, AppZone, which is a fintech business, they actually saw a positive impact. They have a number of fintech products that help facilitate transactions for the banks and the microfinance operators. And I think when COVID-19 happened and there was a lot of restriction in movement, a lot of those products came to fore. And so there was pent-up demand for that. And that actually catalyzed and helped accelerate our investment in the business.
So Cardinal Stone Capital Advisors invest in two of West Africa's leading economies, and that's Nigeria and Ghana. We'd just like to find out what's the difference in investment climates between both countries?
Well, I mean, Nigeria alone is very heterogeneous. And so by the time we talk about Nigeria and Ghana, there are a lot of differences. I'm going to just focus, just pick three. Number one is size of the economies and the sectors, which in effect typically affects the size of the deal. So on average, you'll see a wider range of deals in Nigeria, more bigger ticket deals in Nigeria. In Ghana, they're more tempered, they're usually smaller. So that's one. Secondly, is just in recent times, the macro environment and perception of stability. I think the world will tell you that Ghana has sort of had repeated transitions of power where people have not been concerned about insecurity. That's not been the same about Nigeria. It's never really happened, it's never really been bad as people predicted, but there's always that fear in Nigeria, not as much in Ghana. Also, in the last couple of years, the Ghanaian economy has kind of been stable and has been actually positive, while the Nigerian economy not as much. The third is currency. This is either here nor there, because I think the Nigerian currency is very closely managed by the CBN, while the Ghanaian currency is more free-floating. What that means is there's usually a lot more over time devaluation happening in Ghana versus Nigeria. However, there are big questions around how fundamentally appropriate is the Nigerian currency. So those are three of key fundamental differences between the two economies.
But in terms of regulations, what are the major differences, and what do you think, or what would you like to see improved in terms of regulation?
Well, so I'm not a regulatory expert, and on every deal in every country, we always bring the lawyers and the regulatory people to the table. But I'm just going to highlight three differences that affect us PE investors. One is the recently introduced Consumer Protection Agency regulation that requires private equity investments of certain levels to seek approval. That's a recent regulation, and it's in Nigeria, which doesn't exist in Ghana. And it's actually creating a little bit of it's increasing transaction timeline, transaction complexity for many PE transactions in Nigeria. So that's one that doesn't exist in Ghana. Two other regulatory items that actually affect us as capital raisers, because we always look to raise money from the local environment as well. In Nigeria, the fund managers, the SEC, the capital requirement for SEC-regulated fund managers is actually quite high compared to in Ghana. It's around $300,000 here. In Ghana, it's about $30,000. So more people can set up funds over there and access capital from local pension funds. It's harder over here. I think related to that, which is better for raising funds in Nigeria, is we don't have capital gains tax. So investors could find it attractive to invest in private equity. While in Ghana, I think they have an 8% capital gains tax, although I think they are lobbying to remove that. Those are some of the regulatory matters that kind of affect us as fundraisers and fund deployers in our different markets.
But then in terms of the people now, I'm sure you have like a difference in social-cultural environment in Ghana and in Nigeria. What's it like, even when you're in terms of how do we call this now? I mean, the sociocultural environment in both places. What's it like?
Okay, so I'll start by saying, even when we stay in Nigeria, we're so different. Doing a deal in Lagos and Ilorin and Calabar, Warri or Kaduna, very different. So Nigeria alone, we're extremely different. Just the way we live, how we engage, how we socialize, and how you get a deal done. So Ghana is similar, right? I think it's important that we come with global structures, but we always have to look local. On our team, one of our senior members is a Ghanaian, and she's been with us for 8 years now. And I think we've been doing a lot of stuff in Ghana, but I think it's very helpful to, when you go on every deal, it's about the individuals on that deal. It's good that we all speak English, but we're very different. So I'm being careful. We're very similar, but we're very different. Almost just as similar and different as we are across Nigeria. I don't know if I've answered your question.
I mean, you've answered the best way you can. You said you were being careful, so that's fine. But then one would wonder, how is private equity investment different from other investment classes, and what is a J curve?
Okay, so I'll say there are three key ways. There are many ways that private equity is different. One is time, right? And I think that's related to the J curve. Your typical private equity deal takes 6 to 9 months to close, from introduction to close, sometimes even longer. And when you make the investment, you're typically in there for anything from 3 to 8 years, sometimes longer. And what the J curve is when you invest, there's a lot of work you do with the private equity, with the portfolio company. And the first 2 or 3 years, there's usually a dip in value, right? Because although you're doing a lot of work, you're not seeing it reflect in the revenues of.
Okay, so I think we have lost Mr. Jembe. Well, while we try to fix that, we'll just look through some of the. Okay, Mr. Jembe, you were saying something. You were explaining the difference between private equity investment, and other investment classes.
Yeah, I'm sorry. I don't know why you lost me. I was saying time is the first thing. 6 to 9 months to close the deal. Hello, can you hear me?
Yes, I can hear you. Go on.
Yeah, about 6 to 9 months to close the deal, and you're typically in the deal for about 3 to 6 years. And the J curve, like you asked, typically the first 2 or so years when you invest, there's a dip in value because you're building, right? You're building for the long term. You're not seeing it reflect in increased revenues or profitability. Unlike portfolio investors, they want to see results in 3 months, in 6 months, and they want to see things growing. In private equity, there's a J curve because there's a dip in value perception in the early years, and the value grows eventually. The second difference is the skills required. In private equity, you need a plethora of skills, right? From corporate finance to strategy to operations to controls, and many times even technical, depending on the sector. The final is it's a very specialized asset class in terms of the structure, governance, how long it takes to raise a fund, and all the things that come, all the bells and whistles that come along with it.
The first quarter of 2020 is gradually coming to an end. So what has it been like so far for you folks at Cornerstone Capital Advisors, and what is your outlook for the rest of 2021?
It's been positive. Like I said, last year, there was a lot of reflection, and it really helped us that we had closed our fund, right? And like I said, we also took a step back and we looked at which industries and which players were a little bit more resilient, which ones were challenged. And it's a good time to have capital. From our background, we started Cornerstone, the parent company, in 2008 at the beginning of a downturn. And we've always learned that there's no better time to invest than towards the end of a downturn. And so we have capital, we have some good pipeline opportunities, we have a solid team. So a lot of optimism and excitement. The economies are opening, the vaccine. So very optimistic, very positive.
Well, I mean, you mentioned that you had some time to reflect and look at, various sectors. So what sectors are you looking at investing this year?
So, I mean, we're generalist fund, but from my experience, just over time, we have six priority sectors, right? Consumer goods, industrials, agribusiness, financial services, healthcare, education, and education. This year, I think we want to take it in terms of we have three really advanced pipeline opportunities, one in the healthcare space, one in the consumer services space, and one in the industrial slash agribusiness space. We have a few more that we're looking at, a number in the education space, and a few more financial services. I think what we do is we take a look at our portfolio, our existing portfolio, our pipeline, and as we make investments, we have a portfolio construction that we do where we don't want to be overweight in certain sectors. So as we take off and we make some of these investments, as we close them, we'll be determining which other investments we might kind of temper down because of our portfolio construction.
All right, so CCA announced the final close of the Maiden Private Equity Fund and First Fund Investments. Can you tell us more about these funds and what it aims to achieve?
Well, yeah, the CCA Growth Fund is a growth fund to support SMEs in Nigeria and Ghana. I think with the capital, we want to back ambitious but grounded founders that are basically driving transformational change in their respective sectors. We provide capital of $5 to $10 million. And we bring to bear all our entrepreneurial and business building background where we support them. Typically, your average entrepreneur that has grown his or her business for 5 to 10 years is probably wearing 5 hats more than they should be wearing, because that's just what they have to do with the capital they have. And some of those entrepreneurs have the ability to grow to the moon, but they don't have the capital. And they don't even have the bandwidth to think about all those things and to hire the right people, to bring in the right resources. And that's what we bring to bear in helping catalyze growth with these businesses.
So how many investments does this fund target, and has there been any impact made so far?
Oh, yeah. So from the fund, we expect to make about 8 investments. We've already made 2 exciting investments. One is iFitness, which is Nigeria's leading fitness chain. When we met them, they had only 5 locations and they had less than 3,000 subscribers. Today, despite COVID, despite even being shut down for 6 months during COVID, since they've come back, today they already have 10 outlets. They have 7,000 subscribers. Before the end of this year, we expect to get to 20,000. And when we talk about subscribers, we're talking about people that we're impacting, how they live, how they take care of themselves. They're focused on health and wellness and in a fun, vibrant community. So that's one investment we're really excited about. And the other is AppZone that I mentioned earlier. Like I said, they have a lot of fintech products that are really facilitating transactions at a lower cost with more efficiency. And they had a lot of pent-up contracts that they needed capital to implement. And since our capital has been injected, they've just got on their way, and they're basically helping unleash their productivity to the market.
So while cybersecurity is a top priority for private equity firms and their portfolio companies, are you facing additional threats and vulnerabilities now that there are significantly higher levels of remote access to systems?
Well, I think the whole world is facing that, period, right? So we're no different. And I think part of what we're all doing, last year, apart from just sitting down and thinking about operationally for each of our businesses, we all have to take a step back and say, this thing about cybersecurity, we're going to be doing so much more remotely. There's a higher bar now that we all need to think about. So the answer is yes, but I don't think we're any different from other people. I think, in fact, maybe not as bad because we don't do retail transactions as much as a fund, but some of our portfolio companies do. But we are facing it like the rest of the world is, yes.
Well, we had spoken about regulations between Nigeria and Ghana, but let's bring it back home now. What sort of regulations are needed in Nigeria for private equity to thrive?
I want to be careful. Just for CCA, even from our background as Cardinal Stone, we're always careful to rely on or hope for regulation to drive growth. I think I'm not sure there's any regulation right now or significant regulation that is hampering us significantly. I think the biggest thing that could help us is better education and better understanding of the private equity asset class. I think the understanding that private equity is not here to take over people's businesses, but is here to help entrepreneurs fulfill their vision. Private equity is coming in for 5 to 7 years, and it's not a lot. The managers, it's not the managers' money. They are managing other people's money, and they're going to return it. Their objective is to come in and drive that growth. I think the other thing I'll say is more activity by our local pension funds in the space will be really helpful. But I'm not sure regulation is what we need.
All right, Yomi, thank you so much for your input on the program. Pleasure having you on the show tonight.
Thanks for having me. Have a good day.
Yomi Jembawon is the co-founder and managing director at Cardinal Stone Capital Advisors. Well, we're moving on now. The Central Bank of Nigeria's Monetary Policy Committee held its second rate meeting for the year, and it held all rates unchanged, as well as other parameters. Now, the CBN governor also says the country is still maintaining a managed float exchange rate, contrary to the recent report by Bloomberg that the CBN has adopted a flexible rate in its foreign exchange policy. Now, let's take a listen to what the Apex Bank governor has to say.
Nigeria has not changed from its foreign exchange management policies. Nigeria still remains on a managed float. What does the managed float regime mean? That the central bank, being the institution that has a core mandate for foreign exchange in the country, would run the market, see to how the market operates, depending on its reading, how exchange rate moves in the market, will come from time to time to intervene in the foreign exchange market. It might interest us to know that since January, the CBN has not intervened in the ironing window. The market has always operated within a band of around close to about 409. In fact, at some point, it attained 412, went to 413, and began to move. And that is where it's supposed to move. And then central bank's job is to watch the market and see how it's operating, and from there determine whether or not it should intervene to moderate the rate in the market in line with our own reading of where we think exchanges should be.
Well, that's all on Capital Market tonight. Thank you for watching. I'm Edidiong Iwang. Have a lovely weekend.